Good morning, everyone. Welcome to Windsor Brokers Live Daily Market Outlook for Friday, 14th of September 2012. I've been criticized that sometimes I say the wrong date or wrong year and so on. I have good feedback from my friends. And just a few days ago, they asked me in which year we are. I said 2012. Then they say, you listen your session and you will see that you are still in 2011. So I do apologize to everyone for this small mistakes. As at the beginning, always I have 1 million things in my mind to say, so sometimes I miss it despite having the calendar just in front of me and seeing the date and the exact time. Mistakes happen. Anyway, we are at the last day of the week, the day after a big bang yesterday from Fed. That was basically widely expected, but still there were some part of analysts and commentators that were seeing, and I mentioned this yesterday in our session, that possibility of this action being already priced in the market is quite respectable, but unfortunately they were wrong. And this morning I had a conversation with a few friends that were stubbornly shorting euro in order to see some lower prices as they followed this way. And they mentioned to me that basically you said yesterday. I said yes, I mentioned it, but just as a possibility, though I wasn't convinced. And I told them, if you have read our written analysis that appear in a number of financial sites, then you will see that I was still aiming higher, and the 130 was target despite any possible obstacles. And of course it happened as Fed launched its another aggressive stimulus program yesterday, saying it would pump approximately $40 billion into the U.S. economy every month until they see a sustained upturn in the weak jobs market. This central bank's decision to tie its controversial bond buying directly to economic conditions was an unprecedented step that marked a big escalation in its efforts to drive U.S. unemployment lower. As a result, stocks jumped higher. The dollar was significantly lower across the board, with the gold hitting a 6-month high as investors braced for a fast end of the inflation. Unlike the euro, as we said, hit levels above 130. That was our initial target, fresh 4-month high, while sterling hit also our target at 162.00, 162.04 was high, while dollar yen sunk below 78, 77. 12, I think it was the lowest, just ahead of, again, our target mentioned yesterday at 77.00, while dollar Swiss dipped down to close to 93, actually testing the medium-term trend line, bull trend line at 93.10. As said, gold hit fresh highs at levels above $17.70. $17.77.75 was the highest, just ahead of yearly high at 1790, while also the crude oil jumped significantly higher, finally broke above the recent congestion and the previous high at 98.27, hit levels 99.73 so far, so approaching again another of our short-term targets at $100 per barrel. We are just a few cents below this level, with the positive trend established on most of instruments against the dollar seen unobstructed now. If you read our written comments this morning, you will see that, and we will mention it in our technical part, that most of the instruments are remaining in the uptrend or downtrend unobstructed, especially the euro and the sterling unobstructed, despite quite overbought conditions on the lower time frames studies. As said, Fed's action, unlike in its two previous bond buying actions, the Fed said it would only purchase mortgage-backed securities, hoping in part to unstick a housing sector that Ben Bernanke called a missing piston in the U.S. recovery. Comments from a top Republican charged that the move was a bid to help President Barack Obama ahead of November's closely contested presidential election, while Republican nominee Mitt Romney campaign said it confirmed the failure of Obama's policies. Bernanke dismissed talk that the Fed was taking sides, saying it acted solely because of the dire state of the U.S. labor market. That was basically the brief overview of yesterday's Fed's action, and of course market reaction. For today, I would say we might see some sort of stabilization of the current recent quite strong market actions, though it's the end of the week and quite a busy calendar for today. Also the end of the week closing positions might be trigger for some reversal action in the markets. Europe starts at 9 o'clock GMT with the Eurozone inflation for August 2.6 forecast unchanged from the July's release. The same with the core CPI at 1.7% in August. Eurozone employment change for second quarter is also forecasted to stay unchanged at -0.2%, and that will be all from Europe. America is having a much bigger calendar with the US CPI for August monthly release in ticking higher to 0.2% compared to 0.1% in month of July, while this is the core CPI, and the CPI monthly for August is expected to go by 0.5% compared to 0% in the month of July. Retail sales from US for August at the same time 12:30 GMT are forecasted at 0.7 versus 0.8% in July. This is a monthly release, and the core retail sales for August are forecasted at 0.6% compared to 0.8% in the month of July. At 13:15 GMT is a capacity utilization rate for August in US 79.4% is forecasted, slightly more optimistic from the July's reading at 79.3. And at the same time, we have industrial production from US for August decrease 2.2% compared to 0.6% in from July's release. University of Michigan consumer sentiment for September is due at 13.55, and they expected to take a lower. 74.1 is September's forecast compared to August release at 74.3, and the U.S. business inventory is at 1400 GMT for July are expected at 0.3% compared to 0.1% on the release of month of June, and that's all from today's calendar. I suggest now we move to our technical part and see the latest movements and the expectations for today. As said, starting with Euro. Good picture shows on the daily chart where strong acceleration was seen on a break above levels at 127 and 127.50, where the pair accelerated the upside. The break above important and strong barrier at 128.30, where it's 200 days moving average, and the main bear trend line drawn of a yearly peak at 134.87, as well as regain of psychological resistance, and the previous range floor at 130.00 has so far reached 130.53 en route towards our next upside targets at 131.80 and 132.00. As said, the daily studies are still pointing higher and still show some room for the further extension, while the pair continues to head higher despite overbought conditions on the lower time frames. This especially shows on the 4-hour chart, where all indicators are at their extreme points, yet no any firm signal of any corrective action, as all are still pointing higher. As said, one break above 131.00 as initial barrier is to open 131.50 and 131.80 ahead of 132.00 next round figure resistance, and basically before this we have the 38.2% Fibonacci retracement of the long-term down move from 149.38 1st of May 2011 record high of euro at 38.2% retracement from 149.38 down to 120.42, as well as 131.80 as said, and 132.00 above which another significant resistance is 132.77. Currently is the main bear trend line drawn of 149.38. So far as set, the larger picture is still unobstructed bulls, especially that some very important barriers have been taken out. Full focus is still towards the upside. On the lower time frames, corrective action, I would say at this point, a brief corrective action is seen quite likely as hourly RSI started 2 point lower. We might see some easing down to 130.00 as our initial support ahead of 129.35, which is the previous high, and it's also the, is it 129.35, pardon, reinforced by 4-hour 55 days exponential moving average at 129.31. So this is offering quite good support, while the main short-term support lies at 128.30, the previous strong resistance, now reverted to support, broken bear trend line and 200 days moving average, and basically only break below this level would be quite softening and weakening the current tone. Otherwise, anything above this, I would say, to be seen as a corrective action, though so far such a deep dip is not seen in the near-term price action. I would say the ideally reversal above 129 could be seen as a good scenario in case of any reversal, but bear in your mind that end of the week profit taking might trigger some stronger reversal and push the single currency even lower. And the sterling also continued its strong uptrend. The 162.04 was this morning's high seen on the opening of European session. 4-hour studies, 1-hour studies are extremely extended and they started 2 point lower. We can see the RSI and stochastic already moving towards the downside. That could be initial signal of reversal, while the 4-hour studies are still firmly bullish despite being at extreme levels, with some corrective action not ruled out, as 61.30 previous high now acts as initial support, along with 161.00 round figure support, reinforced by 20 days hourly moving 20 days 4-hour exponential moving average. And I would say at this point the strong support lies at 160 and the 159 zone, and basically break below 159 would be risky. Otherwise, any dip lower of this strong rally could be seen as corrective action. This is the latest uplift from 157.69. We are talking about this level, so let's just take a look at the levels that could be important. As said, around 160.30 is 38.2%, and 159.35, the previous highs, is 61.8%, below which we have 159.00 and the trend line support at 159.20. Basically, loss of 159.00 could be risky at this point and could weaken more significantly the short-term strong bulls. Any reversal above 159 would be just seen as a higher low and a possible extension higher, with the levels mentioned above 162, 162.50 and 163.00 as our main upside target. This is the yearly peak of British pound against US dollar, posted on the 30th of April 2012, and this is our main short-term target. And as dollar lost ground, the dollar yen continued to dip lower, with the latest extension through after losing a strong 78 support, hitting a 77.12, just ahead of a 77 low. I think we can see it on the weekly chart, with the strong downtrend from 84.17 yearly peak, now looking for further extension after losing 78 and 77.65, 77.00, with yearly low at 76.00, posted on 29th of January 2012. Basically, it's, I would say we are wrong for a few days. It's 1st of February 2012, seen in a near-term focus. The structure on the daily remains firmly bearish and sees potential of further extension lower as we have the that cross on the 90 days over at 200 days moving average at 79.25. That puts additional pressure on the technical outlook. Set 76.00 seen on a break below 77 as initial support, with the minor corrective action seen on already triggered on the hourly chart studies, with the initial resistance at 77, minor one at 77.70, and more significant at 78.20 previous strong support zone. Ahead of this 77.80 is the previous low and the 20 days exponential moving average, while 78 level has been reinforced by descending 55 days exponential moving average, and also marks approximately 38.2% retracement of the down leg from 79.65 to 77.12. Anything below 77, minimum 78.50 and 78.80 would be seen as corrective action, while only break above 79, our key near-term barrier, is set to turn the short-term focus higher and prevent pair from further easing. Otherwise, break below 77 is set to open 76.00, and not ruled out to revisit a record high of dollar yen from October 2011 at 75.56. And of course, the dollar Swiss, again, dollar lower across the board, reflects on the pairs price 93.11 level seen so far, as we can see on the daily chart, testing the larger trend line of 2012 low at 89.29 through 90.00 and 90.41. This is the last strong obstacle on en route towards the downside, 93.00, and then 92.50, the previous high of 16th of April 2012, and 92.00 is around the figure support as bears remain firmly in play, and the daily studies, daily indicators, RSI is already in the oversold territory, yet no any firm signal of reversal. This could be a suggestion for some corrective action. On the lower time frames, for our studies are already in the red territory, yet no signal generated for reversal, but in any case, any bounce higher would see the previous supports 93.40, 93.60 as initial mild resistances, while more strong barriers seen at 94.00, where we have the 200 days moving average exactly at 94.00, and approximately it's close to 38.2% retracement of the latest down leg from 95.78 to 93.11, and I would say a break above 94, firm break above 94 is required to ease the immediate bear pressure, though. Clearance of levels 94.80 and 95.00 would be more a firm confirmation, and would signal actually a near-term basing ahead of a possible stronger reversal. Otherwise, any reversal under 94.00 will be signaling the lower top and the fresh extension lower, as bears continue to dominate on the short-term structure of dollar Swiss. And the crude oil, as said, finally broke above its recent congestion. Where do we see it on the 4-hour chart? Excellent. Broke above its recent congestion between the 97.70 and the 94.00 approximately, with initial break seen yesterday, the day before yesterday, hitting 98.04, but stronger reversal dipped down to 96.50 zone, where the good support was found, and basically dips contained by ascending 20 days moving average and the 55 days one at 96.40. I had a fresh strength. Of course, yesterday's Fed's release gave additional boost to, as it pushed the dollar lower, gave additional boost to the commodities, we saw the break above initial 98.00 and the key barrier at 98.27, also clearing 99.00 with 99.73 seen so far, just ahead of our short-term target at $100 per barrel, above which we have immediate barrier at 167, low of 10th of April 2012. Still positive tone, and the fresh momentum seen building up on the daily chart sees potential for further extension higher, as 200 days moving average currently at 96.56. That basically contained the yesterday's dips, underpins the current action, and the most likely scenario would be a revisit of $100 per barrel. Any dip below 96.50 zone would be seen as a delay of bulls and signal further movements within the previously established range, but quite unlikely at this point, as a strong rally is seen extending higher, and the corrective action should be contained approximately at or above 98 zone in order to maintain the current bullish structure in play and keep the immediate focus at the upside. And finally, gold, that has nearly fully retraced its, where we can see it at best, has nearly fully retraced its down move phase from 1790 yearly high of 2012 posted on 29th of February, that dipped down to 1526.90. This is a critical support area, as shown on the weekly chart, where we had several attempts so far holding the downside, preventing basically the yellow metal from the stronger and more significant corrective action of the larger uptrend that goes back in past 10 years, rising from levels approximately $250 that peaked at $1,920 per ounce in September of 2011. As bounce from this dangerous zone continued, the fresh high seen yesterday at 1777 now sees full focus up at 1790, our initial target, to fully retrace the phase from 1790 from February 2012 until May 2012 at 1526.90, as the daily structure remains positive, but extremely overextended conditions and overbought conditions might suggest some corrective action. We don't see any reversal signal yet, at least on the daily chart. For our ones are starting to point lower, yet no clear signal of a reversal, but in any case we can define the supports as the previous highs at 1750 zone that also mark 23.6% of latest uplift from 1646 to 1770. What are we? 1777, seen as initial target, reinforced by 4-hour 20 days exponential moving average. I would say more significant support is around 1725-30 zone, where we have the higher platform and 38.2% retracement, and close to this is also the 55 days moving average, and ideally any dips should be contained here or any level above 1700, 1700, with 1711 seen 50% retracement and 61.8 at 1696, where is also the trend line support. So I would say at this point any break below 1700 could be quite risky, and will be a signal for a stronger corrective action. So far bulls remain in play, but corrective easing not ruled out, as overextended conditions on the lower time frames already a signal that we might see some pullback lower, and especially that strong rally requires also the profit taking, and today's last day of the week, this is increasing possibilities of a stronger reversal of the yellow metal. That was all from my side. Now it's your turn. If you have any questions, please submit them now, and I'll be glad to answer. Okay, it seems that we have no questions. We exhausted all our subjects for today. In any case, I would like to thank you all for being with us, and hope that our outlook and analysis will be useful for your today's trading. We expect you back on Monday, when our regular session will start at 7:00 GMT, our standard time, and expect to see you again with us on Monday. Until then, I wish you nice Friday's trading, a very profitable trading. If you were short dollar and long any opposite instrument, I think it's a good time to take some profit, and of course a good and relaxing weekend, as the week ahead will bring us some new trading opportunities. Good luck.